Welcome to Thoughts on the Market. I'm Michael Zezas, Global Head of Fixed Income and Thematic Research for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the debt ceiling and its impact on markets. It's Wednesday, May 10th at 10 a.m. in New York. Congressional leaders met at the White House on Tuesday to hammer out a deal to raise the debt ceiling and avoid a government bond default. Reports following the meeting suggest little progress was made. That news shouldn't necessarily be surprising or discouraging. Initial rounds of legislative negotiations are often just a venue for each side to state their position. It often takes the urgency of a nearby deadline to catalyze compromise. While this isn't the first debt ceiling challenge for markets, it may be the most critical one, at least since 2011. As we've said before, investors need to take seriously the idea that we do something that hasn't been done before. Cross the X date, the date after which Treasury doesn't have enough cash on hand to meet all obligations as they come due. So it's useful to quickly revisit what that would mean. In short, it puts a bunch of options on the table, but most are not good options, suggesting some markets may have to price in greater downside, at least for a time. A benign and plausible outcome would be that if the X date is crossed, the resulting concern among policymakers, voters, and business leaders around missed debt, Social Security, infrastructure, and other payments creates enough pressure on Congress to quickly force a compromise. Other outcomes are less friendly. The White House could choose to avoid default by ignoring the debt ceiling, citing authority under the 14th Amendment. But that could just shift uncertainty from the legislative process to the judicial one, as courts could ultimately decide if the U.S. defaults. The White House could also choose to prioritize payments to bondholders over other government obligations, but this could interrupt payments into the economy that support a substantial amount of consumption and GDP. And of course, default would be a possibility, but given its far more considerable economic and political downside relative to the other options, this outcome would not be our base case expectation. So how could markets react? Here's what to watch for. The Treasury bills curve could invert further, with shorter maturity yields rising more relative to longer maturity yields. In equity markets, volatility should pick up considerably, and any resolution that crimps economic growth further would underscore the cautious stance of our equity strategy team. So, developments over the next couple of weeks will be critical to track. Thanks for listening. If you enjoy the show, please share thoughts on the market with a friend or colleague, or leave us a review on Apple Podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.